Traders, welcome back to another video. And in this one, we're going to talk about liquidity, liquidity grab, liquidity run. We're basically going to talk about where is the money? Where is the money located? And we want to figure out what the market is doing with that money. Is it grabbing that liquidity? Is it grabbing that money and moving in the opposite direction? Or is it running through liquidity? In order to find that out, we need to look at the charts. So hopefully you guys are seeing in front of you my trading view chart. I have the weekly profile on a 30-minute rotation, and we're going to speak about last week's movement. Monday the 4th to Friday the 8th. So it's going to be this area right here, Monday through Friday. We want to locate liquidity and we want to see what the market potentially can do with that money. All right. So let's start with Monday the 4th. Monday the 4th pretty much opened in slightly in the range of Friday the 1st. All right. So that would be our profile of reference. Monday open looks like at 216.55. So roughly here is where Monday opened in this area, which is just inside the top of the range of Monday the 1st. So slightly in balance. Mhm. So where is liquidity? Where is the money? Well, if you look at every trading book that you may have read or any YouTube channel that most 99% of YouTubers tell you, especially if you want to be a swing trader or if you're interested in being a swing trader, they all teach you to put your stops just above swings. So if we're looking at this profile here, which is Friday, August the 1st, there's a bunch of swings in here, right? There's a swing low, there's a swing low, and swing low here, but also is a swing high, right? So just to point that out, let's see if I can grab the right marker. All right, here is a swing low. Here's another swing low. So basically price came here, swung low. Price came up, hit 216.59, swung low. Here's another one here. Price came up to this area, 216.03, swung low. But then you also have swing highs. Just like we have swing lows, the price came all the way down here, right about right there, right? Swung higher. Price came here, swung higher. Price came here, swung higher. And price came down to here and moved back higher. All right, so you have your swing lows and your swing highs. Every trading book that I'm sure you may have read teaches you how to place your stops. And it's always 2% above a swing low, right? So 2% above there, or a swing high, 2% above here. Well, I can tell you that since this is common knowledge, this is in every trading book, that the bigger players know where your stops are and they know where to grab them from. This is called liquidity. This is, i.e., where the money is located. Okay. So the money is located here, here, because these are swing lows, right? Here. Money is also located here, here. This is the liquidity here. And lastly, here. All of these swings, this is the swing high back up, price came back down, swung high up, price came down to here, swung high up. So we know that you're gonna place your stops there, right? 2% just below that area, whatever that low price is. And also your stops are here. Price goes up, swings down, comes back to this area, swing down, comes back to this area, swing down. We know that this is where every retail trader places their stops. Okay. So understanding where the liquidity is, where the money is, we can understand how to take advantage of people who do what the 90% of traders do. Okay. Because they all read the same books. So let's pick this area. Again, we're going to look at Monday, the 4th, which is here. In order to look at that, we need to find out where the money is and what other participants are doing with that money. Are we going back to that area, back to a swing high to pull money away, or are we going to run through it? All right. So we know that on Friday they were coming back to the 216.62 area roughly, pulling that money and dropping it, pulling it or grabbing it, I should say, and dropping it. So I want to place just to kind of get an area of interest. We know that they were pulling money from here. Okay. On the first, they were pulling money from there. Let's take a little step further. Let's go further in time. All right. So this profile of August 1st is trading in the profile of July 1st. So let's go all the way back here, and we can get a bigger and better understanding of what the market was trying to do in that area. If we go back to July 1st, well, even July 30th actually is even better. And let me make that just a little bit bigger. So here is July 27th and July 30th, and then finally June 27th, June 30th, and July 1st. Sorry for the mix up on the dates. So on June 27th, price was coming into this area and going back down. So pulling money or grabbing money, dropping. On June 30th, again, come back to this area, pulling or grabbing money and dropping, grabbing liquidity, knowing where your stops are, and pulling. Finally, July 1st, there was no more money to grab, no more stops to take out. So they ran through liquidity. So this is liquidity grab, liquidity grab, liquidity grab. Again, on the 30th grab, and then finally July 1st, they run through liquidity. So this is liquidity run. All right. So now we're running through that area. And I would even, looking back at it, I would make this a little wider because this is a POC here. So let's make this just a little bit bigger. And I'm saying that I will say probably around the POC area would be a great area to place that area. So about right there actually would be a better spot. I would even say right here because that's also a pull. All right, so we're running through that liquidity. Now, when we come back to it, here July 16th, run through it. See, we come to it, pull it, and then run through it. We run through it. Then we finally come back 16 days later, July 16th. Now that becomes a liquidity grab again because we know most retail traders, once we run through it and we find a swing high, we know, like every other trading book, that you will place your stops just below there, swing up. We can also say here, swing up. So when we finally get back to it 16 days later, the market knows there's money here. We run through it. There's money there. Let's take that money and let's take that money and finally go in a different direction. So we know that in this general area, what happened August 1st, we look back in time, the market pulled liquidity, pulled liquidity, pulled liquidity, and then finally, make it a little bigger, finally, July 1st, we ran through it just to make a swing high again, After we come back to it, we know that you're going to put your stops there, there, and there. 16 days later, market comes back to that general liquidity area. Take that money out. Let's see. Take that money. Gonna take this money, and then we're gonna take that money. Okay. So it just in this example alone, we didn't even get into Monday the 4th. We're just talking about in that general area of liquidity, right? Seeing what the market did before by pulling it, running through it, coming back to now pulling that money, pulling it to go, back to the upside. To now we can see once we finally get to August 1st, pre-market or the futures market ran through that liquidity, right? We ran through it. All of this is a gap, and which is the futures market running through liquidity, right? So this was once selling, selling, selling because there was a bunch of stops on the sell side that became buying. Then it becomes stops on the buy side, which was taken out to now running through those buy stops because the market says there's no more money to grab. To now that becomes a swing high. I'm sorry, swing low, and another swing low. Hopefully that is showing where the money is. We're talked about liquidity grabbing. We're talking about liquidity running, and we're finding out where the money is actually located. And we haven't even gotten to talking about Monday the 4th. We're just going out and looking at the market as a bigger picture to see exactly what has happened in that area. So now that we have a better understanding of what has happened in that liquidity area, and we've seen what the market has done in finding where the money is located and taking advantage and grabbing that money, now we can finally look at Monday the 4th. Now we have a greater understanding. So we know that the market on the 1st, which was Friday, had a swing low. Looks like it took out that money uh, the same day around noon, took out this money. So basically, what happened, this was a swing low. The same day, price came up into it, grabbed those stops, and went back down. So that was a liquidity grab in the same day. And then this created this swing low. So money is located there. Okay. All right. So now we can focus on, now that we have an understanding of what has happened in that liquidity area, where the money is located, has been grabbed. Now we can focus on potentially what is going to happen or what can happen on August the 1st, 4th, Monday. So we know there's money sitting here at least, right? Because this money hasn't been grabbed yet. This money has already been grabbed at the beginning of the trading session, August 1st, but this hasn't. And so far, this hasn't. Right there. Okay. Monday, August 4th, actually opened here. 216.55, I believe the number was. 216.55, yes. So we have already, just by opening above this liquidity, this swing low, the futures market has already taken out this liquidity, have already grabbed this money. So what could the next area of opportunity be? Well, the next one is here, right? If this is an area where we rejected from, and I don't like to use the rejection, but what it is grabbing the money from the areas of liquidity. Then this area right here, roughly 216.63, can be an area where you can look at this and say, well, there's money here. The market is always looking for liquidity. It's always looking for where the money is located. This could be a potential area to play. Price goes up to it and we fade down. Now, what you don't know, which most of us will never know unless you are, in the bigger corporations, is you don't know how long these moves are going to make. How long these moves are going to last, I should say. You don't know if it's going to be 5 minutes. You don't know if it's going to be an hour. You don't know 10 minutes. You have no clue. But what you do know is how and where the money is located. And what you do know is that the market is always in search of liquidity, i.e., where is the money? Always in search of the money. So there's a couple different ways you can play this. I will personally have played the fade, which basically I would play sell because I know there's money here sitting here. All right. We've already ran through it in the futures market that the session before. So the likelihood of us fading back down, even if it's for 5 minutes, money is there. So I would have played the fade down, and you can see if I make it a little bigger, here is Monday the 4th. Here is the open. It came all the way up to 217.05 roughly, and then it came all the way down to 215 80 98. So that's a big area of profit to make, right? So we rejected it and come back down. So we grabbed that money, right? And then came back down and then grabbed this money before going higher. So this opportunity, which probably lasted about the first 5 minutes of the market, was an opportunity to sell it, get that money just like the bigger players would do, and take about a 10 to 20 cent options profit and would be able to log off and be good for the day. All right. So that is an insight on liquidity grab, liquidity run, locating money, basically taking advantage of what retail traders read and do 90% of the time. Taking advantage of what the 90% do to be part of the 10%. Okay, so that's an example of Monday, August the 4th. The next one we're going to talk about Tuesday, August the 5th. And we're going to again locate liquidity, locate those liquidity areas, understand what the market has done in those liquidity areas. Is it continuing to pull or grab liquidity to go the opposite direction? Is it locating the actual money where these stops are located and going in the opposite direction? Or is the money or is the market running through to do a liquidity run? We'll see y'all on the next one. Thanks. All right, traders, let's talk about August the 6th, which is that Wednesday of last week. On the screen, you'll see that August the 6th opened roughly around 220.95. Immediately, I'm able to see the liquidity area. But first, let's talk about where we are. All right. So we are currently in the range of last session. The last session would be August the 5th. The very top of last session's move or August the 5th's move is roughly 220.40. And the very bottom of that, let's go ahead and put a rectangle around it. So roughly 221.40 down to roughly let's say 218.09. That is the entire range of August the 5th movement. Price of August the 6th is inside of that range. So this is what we call imbalance. We're in balance of the previous session, the entire move. So August the 6th opened in balance of the entire move. So we're able to not only know we're going to point out liquidity, but we can see if we're balanced or imbalanced. Immediately, I'm able to see because we're referencing the session prior, I'm able to see what liquidity is. I will put liquidity if we go and take a bird's eye view of that area. Last session, before we point out liquidity, opened or came up to 220.40 before fading down. And then later that day came all the way up to 221.06, faded back down. So there is an area of liquidity in this area where it kept pulling, coming down, grabbing, going up, I'm sorry, grabbing liquidity, which was from here, August 31st. Actually, let me point that out in the arrows. Okay. So it came all the way up to 221.40, grabbing that liquidity. So all the way up to 224, grabbing stop orders there before dropping down. And then tried to grab these orders here from the same day that swing low, but didn't go up that far. So we know the area of liquidity of interest is in that area. So I personally will put it just below here. So I will say this swing there. And if I go back and further, we can see why. So here, and I would say probably I like it here because of what happens way down there. So I would say this is an area of liquidity, right? We can see July 31st ran through it after coming and grabbing those orders, that swing low, and then run through it, liquid. I'm sorry, not through it. My apologies. Grabbing those orders and continuing to go to the downside. So it hasn't run through liquidity yet. I'll take that back. This was coming up to it, grabbing orders, and then going in this independent direction. So the next time price comes back to that area, which it did August 5th, liquidity grab, going back in this intended direction. That was the sell. And then more that day here, grabbing more orders to drop. Since pre-market or the futures market didn't run through this area, I would definitely be looking to sell here, which it actually happened, right? So we didn't see price go through it, right? We see price go on the 31st, come up to it, sell. It takes 1, 2, 3 days before it comes back, August 5th, to sell it again. The same day, come back to sell it again. And they did it 3 times here, here, and here. Let me point that out here. There, there, and later on that day there. Okay. So 3 times, and all 3 times grabbed some money and went back in its intended direction. So when it came to August the 6th, the futures market never grabbed those orders, right? There was no grabbing or running through it, especially in the cash session, never running through it. So the likelihood of price going back down into that liquidity or from that liquidity area is a higher chance. And you can see that's what happened. Price on, let's see, let's go back and refer to August 30th, ran through it, which becomes now an area of liquidity to the downside. The 31st has taken it out a couple times, grabbed money and went down. Took 3 days later, grabbed some money again, went down in the same session around 1:30 Eastern time, grabbed that money, went down, and right around 5 o'clock or 4 o'clock, I'm sorry, Eastern time, grabbed some money and went down. So the next session, August the 6th, came back to that area, grabbed more money and went down. So this is liquidity run, turned into liquidity grab, more grabbing on the 6th. And then finally, we can see if you look over to the right, the 7th ran through liquidity. Okay. So let's point out the money. Now that we know which direction we should go into after we see the liquidity run to grabbing, to grabbing, to grabbing, August 6th, we see there's orders there, which is money. There's money there. And right at the end of session, there is money there. And if I make it a little bigger, hopefully you guys can see it. Let me bring that to the front so it's easy to see. Bring that to the front. Okay. So there, and then this one as well. Bring that to the front. Okay. So there's orders here. Again, we all know All trading books tell us to put your stops just above the swing low in this case. Swing low, there's orders there. Swing low, orders there. Swing low, orders there. We know we should be selling the market. When before cash open, we already have a plan that we should be selling the market here based off what we've seen from the past. So there's no surprise that we're selling here. We just want to find out where the money is to grab and then go down. So we know there's money there, there's money here, and there's money here. So when the market opens Wednesday the 3rd, Wednesday the 6th, August 6th, we know we're grabbing money here and we're fading. We're fading down. So there's money, money, money. We already know we should be fading because we're coming back to an area they ran through. So there was no buy orders, become sell orders, sell orders, sell orders. Wednesday the 6th should be no surprise. Grabbing that money to sell some more. All right, that was quick, easy. That happened in the first time frame, which is the first 30 minutes of the market, a period of cash open, ran all the way down to 219.38 roughly. All right. So that was Wednesday, the 6th of what happened after we have ran through liquidity to come back to liquidity to grab, to grab, to grab, and to grab. So we have run through it. We have come back to grab more. So now, because we know, as all of us know by now, if you looked at the first two of these videos, now that's collectively, you know that once we go through liquidity, again, every book tells the same thing. You place your stop orders just above swings, 2 to 3%. Let's go and grab that money. Let's take your money, take your money, take your money, take your money, and go in a direction we all know it should go. All right. So that was Wednesday, August the 6th. I definitely want to talk about Thursday the 7th because price actually opened up into here, 222.76. And even though we've run through this liquidity, oh, there's something down here we need to look at. So let's check out the next one. All right, traders, let's talk about August the 7th. And I purposely left this liquidity from the last one, from August the 6th that we talked about, because let's talk about how we ran through liquidity in the futures market for August the 7th to come to another liquidity area of where we ended up fading down. So again, let's talk about the liquidity areas and let's talk about the money, where's the money located, how we can play it. But first, before we do that, we need to take a bird's eye view. Okay. So we're talking about August the 7th. So obviously August the 7th opened out of balance of the last session of August the 6th to the upside. So the very top of August the 6th was roughly 221.10 and the very bottom of August 6th was roughly 219.34. August the 7th opened at 222.76, which is above the profile the entire day of August 6th. So we have opened out of balance to the upside. So if you take a bird's eye view of this area, we can see that it took us 1, 2, 3 days to get to this liquidity area where we're able to get to a liquidity grab after a liquidity run, come back to it, grab money, drop down, because we know once we run through it, there should be no more buy orders there. So the next time we come up to it, we have a game plan to sell it. So we come up to liquidity, sell, back up to it, sell, and then it looks like it did it again the same day and sold to August the 6th, back into that area, sold it, tried it again around 11:30 Eastern, sold it, and then again at about 4:30, right at cash close, sold it. But this is interesting though, because August the 7th, futures actually ran through liquidity. So this was liquidity run on the future side to end up in opening up 222.75. So let's take a bird's eye view of that area. Now that we've opened out of balance, we need to go to the left and see the next profile of reference, which would be July 30th. And July 30th had a massive sell-off. I believe this was Fed Day. If it's at 2 to 2:30 Eastern, that would have been a Fed announcement. So price came all the way up to 224.98 and then ran and just completely fell all the way down here. So to understand what this was, this liquidity area, we need to go back further. An I spot, and let me get the right tool. To me, we're going to start here because August 31st was an area where they tried to go higher. I would probably have my liquidity in that area, right? Let's try it out and see. So here, I would say from the top of there to about here, I would say right there. And the reason I put it here is because August the 30th, so July 30th, price came into it up to the 224.49 area and then faded back down to 223.50, back up to 224.86. Tried it right before it was like 2 o'clock, dropped it a little bit before fading back, buying back up. And then finally, when Fed came out at 2:30, finally ran through it. So this was a liquidity grab, liquidity grab to a liquidity run or run through that liquidity to July 31st coming back. You can see around 10 o'clock Eastern. They try to come up here, make it a little bigger. They tried to come back into liquidity before fading. So when it comes back into that area, that liquidity run, it went from liquidity buy, liquidity buy to liquidity run. So liquidity grab basically to buy up. Let me actually point them out in a different way here. So this was buying liquidity, price coming to it, buying liquidity to run higher, or grabbing money to run higher. So this is liquidity grab there. Let me make that just a little smaller here as well. So grabbing money, going higher, grabbing it, going higher, grabbing it, going higher to finally running through all of it to now come back on the 31st to now that becomes liquidity grab to the downside to now come back onto it, to back up to it August the 7th. We already know coming back to it, we should be selling it. And that's exactly what we did. We sold it. So where's the money? Well, I already have them circled, right? We had money here that ended up running through. There was money here that the market actually ran through it. So where's the next money to sell? Now we know that we ran through liquidity. Where's the next money we should grab to sell? Well, price opened 222, what was it, 222.70? 222.76. The top of here at this swing was 221.61. So we know all of these people are underwater. Again, every trading book tells the same thing. Put your stops 2 to 3% above a swing, whether it's a swing high or swing low in this instance. Swing low, we already know we're taking out all this money. These people are hurting. They want to get out their trades and they want to get out now. Price, the bigger players know that. So we come into this area of selling and we are dropping. So even though we ran through this liquidity that was, we were buying, we were grabbing to sell, grabbing to sell, grabbing to sell to run through it, you would think the next time we come to it, we should buy. But this case, August the 7th, we actually futures market ran through it and opened here into an area where we ran through liquidity, came back to it, grabbed money, and then they continued down their intended direction. So running through it, come back to grab to the downside. The next opportunity to do that was a couple days later. What was it? I think it was 1, 2, 3, 4, 5 days later. come back to that area where we sold. Obviously, this is a huge selling TPO there. One time frame, 30 minutes down to come back to it. We already know we should be selling. That should be the game plan when we first uh, start looking at charts. Where's the money? Well, the money is here. Pre-market or futures market already took out that. So these people are going to be hurting when cash open begins or when it opens at 9:30 Eastern. We know these people want to get out of their trades and they want to get out now. They don't want to lose more money than they have to lose. Immediately dropping. Immediately. And you can see on Tuesday, I'm sorry, on Thursday the 7th, they ran through not only this liquidity in pre-market or cash, futures market, but during the cash market, they ran through this liquidity. So now this one, if we come back into it, you can see August the 8th on August the 8th, which is Friday, come back to that liquidity to drop it once, dropped it twice, dropped it the third time, and then came back around noon and dropped it again. So let me put a circle around that one. After we dropped liquidity, coming up to this liquidity at the open, August 7th, to drop it, we know coming into the market we should be selling. We know these people are going to be hurting. Drop it, and they dropped it further to knock out this liquidity now. So now we come back into it on Friday, the 8th. We should be selling, coming at liquidity, drop it. These people may or may, well, even though stops are going to be here, I should say. So that's money there. Luckily for them, they didn't get stopped out. Price came into that area, looks like 10 o'clock, drop liquidity or grab liquidity to drop, and then 12 noon, liquidity to drop. All right. So hopefully with these examples, traders, I hope you guys are seeing the market a little differently. Hopefully it shifts your mind away from the retail side of thinking and more into how and why the market moves the way it moves. What is the market looking for? Is it liquidity? Is it money? And where is the money? All right, guys, have a great one. Thank you for watching, and we'll talk soon. Bye.